All right. Good morning, everybody. It's Tuesday, my favorite day of the week. So, Tim and Tim, we're back again for another episode of our weekly Facebook Live show. So, if you're not part of our Facebook group, Making Moves Real Estate Community, please join that group so that you can get more content like this and see our posts and things. Because I know a lot of people just watch these shows on our personal direct pages or on LinkedIn too. So, yeah, Tim, how you doing today, man?
Can't complain, man. Wouldn't do any good if I tried.
Yeah, I wouldn't listen to you. Maybe somebody on here would listen to you, but
I call Vitaly every now and then. I'm like, dude, I got something to tell you. He's like, yeah, go for it. And then after like 5 minutes, he's like, huh? What? I was
you were talking.
I'm sorry, I was cutting my toenails.
Oh, what an odd thing to pop in your head to say. Is that's a
I
response?
don't know, man. It just comes to me. It's natural.
Yeah. All right. So last week, what was it? September 20th, I believe it was. JPOW in the Fed met, and they did not increase the Fed rate. So I think the Fed rate still hovering at like 5.25 to 5.5. And I had an interesting conversation this morning, and it was about where did we think debt was going? And I was like, you know what? We haven't talked about debt in a while, but I mean, Tim and I talk about debt all the time. So we figured we'd come on here and we kind of peel back a layer to the onion and kind of show the conversations that Tim and I have, especially when it comes to debt, as that seems to be a very hot topic with the Fed pausing their rate hikes. It didn't say that they were going to stop doing them entirely. They just said they were pausing. But there was, there's some chatter and some inclination that they're going to start increasing rates again. I don't know, maybe what they're meeting again November 1st. So there's a potential that they might go up another 0.25% November 1st, but I think they just took a pause right now to see how things were going, to see where the inflation was trending, because inflation truly is a lag indicator. It takes time for those things to grow and develop. They're looking at prices of your groceries and gas and like um, rent rates and everything. How are everything being applied against the change in the rates? And one thing is, rates are really high right now. When my wife wants a new car and we were looking at some cars and I saw the interest rate was like almost 9%. I was like, I don't think we're going to be buying a car. So what if I'm saying that? What is everybody else saying about it? So Tim, what are some of your thoughts about where we are in the debt market and where we could be going and what you see before the end of the year?
I First of all, it amazes me with the car thing, because I'm used to most of the time when I ever purchased a car, it was like, hey, 0% or 1% financing or
I
something like
know
that,
my
right?
truck is
Yeah.
0.9% interest.
Yeah. I bought a car one time, and it wasn't that long ago, and it was 0% for
Yeah.
5 years. And I'm like,
I
shit,
got
well,
point 0.9 for 84 months.
well, and that was my question. I was like, can I just do it for like 10 years? I mean,
Yeah. Yeah.
um, but yeah, man, to your point, what are rates going to do? I don't know. I remember having a conversation back in, say, March. I think I was having a conversation in March. I was sitting at a dinner with an investor, and we were we were kind of going back and forth, and we both agreed. We were like, "Yeah, rates are going to come down at the end of this year. I think rates will come down at the end of this year." Did I bet on it? No, but I really, really thought that rates would start to come down towards the end of this year. Of course, at that time, we also thought that the big old recession word was an inevitability, that it was coming, and it might still be coming, but everybody thought it was coming this year, and so far it hasn't. So
I was watching a YouTube video by Graham Stephen or Stefan. Do you know who he is?
I've heard the name. Yeah.
Oh, he does really great YouTube content around all things financial and debt and rates and investing and whatever. I mean, very knowledgeable guy, at least it seems. And he was talking about some indexes that show recessions don't really come apparent until about 18 to 24 months after you've had the event that caused the recession. And a lot of people are saying it was COVID. I don't That's not true, right? It was from the point of when they started to raise rates is when they started to combat inflation, right? So that's kind of like your starting point. And he was saying that was it March 2022 that started? But he's saying by all indications of every single indicator that has shown a recession in the past, that it takes 24 to 18 to 24 months to show. So he was like, we won't even feel or see any type of recession until maybe Q2 of next year for it allowed to, kind of fester and grow.
But you know what's interesting is that he's saying that, right? And then you hear
Hmm.
other people saying, we should have seen it by now, or we should have seen it. It's all, I mean, everybody's going off data and they're trying to make predictions off data, right? And
Hmm.
like sitting here, what's the Fed going to do? And I've seen one, highly connected individual go, "Hey, I think they're going to raise it a quarter point in November." Right here, Goldman Sachs is like, I don't think the Fed's going to do anything in November. I think they're going to hold pat again. So it's all like, who knows? Like I said, like I was sitting with somebody in March who's highly connected to this stuff, and we both agreed, like, hey, they're gonna have to lower rates towards the end of the year. It's not looking like that's gonna happen. Um,
No.
but if you asked me like what my prediction was for next year, I think they're gonna start to lower them next year.
Mm.
um,
Yeah,
you know,
the way that I see this planning out, and obviously take this with a grain of salt, right? Because just like everybody else that's posting about it and talking about it online, it's my opinion. I've been through this before, but not into this while I'm in this business, right? So what I think is going to happen is if they do increase rates again, I think I think we're at the top. And if we're not at the top, we're close to it. If they keep rates the same, what they're doing is they're watching for that inflation ratio to go down. And they're really looking for, I think, what's the 2% or less inflation. But what I think is they've jacked them up so high in order to stop it because it's a lag indicator. And I think inflation's in like the threes now, maybe the low fours. I don't know exactly. But I think that the longer that they hold the rates where they are, they'll get closer back down to their target ratio of 2%. But then what they're going to see over the next 6 to 10 to 12 months is that if they don't come back down on rates, I think we're going to see inverse. It's not
yeah,
inflation, it's deflation, right?
yeah,
Yes,
yeah.
deflation. And I don't think that they want that either, even though that would technically, I think, make the dollar more valuable. But that just doesn't seem to work for everybody's stocks and charts, because stocks, charts only go, let me go this way, that way, right? Up and to the right. So I think that, if they hold it, then we could see some rate reductions in like 12 months time once everything kind of settles down. But I don't think the rates are going to stay up where they are at. I think they're going to still settle down. I think probably a full basis point,
Yeah,
100 bips.
the thing for me that's kind of like, I don't know, the unknown is, you always hear people talking about 08, 09, right? 08, 09. Again, this is way different than 08, 09. First of all, we're not seeing a collapse like 08, 09. The other thing too is, people are sitting on tons of cash.
Hmm.
I was just reading again this morning something that our man Chris Yeagle linked to, and hey Chris, and that it was yet another article talking about all the cash sitting on the sidelines waiting for rates to adjust. So, like Tim's talking about, inflation's a lagging indicator. Inflation starts to come down. What happens? And guys, I'm not an economist. I don't know what happens when all that cash sitting on the sidelines, when rates come down, and all of a sudden that cash starts to flood back into the economy, right? Like, are we going to see inflation again? Like, I don't know. But the one thing I do know is that I keep reading about how this cash is sitting on the sidelines and it's ready to invest. And they're specifically talking about real estate. Like, there's this cash sitting there waiting to buy real estate. And I kind of look at it and go, but if I can buy something today that works at today's rates, and I can own that when people are ready to deploy all that capital and flood that cash back into the market, my third grade education tells me that if I own the real estate now, when that happens, I'm in a good spot. Um, so I don't know. Somebody more sophisticated than me can kind of argue that point, um, but
Yeah. No, I don't
seems
disagree with
logical.
you, right? I mean, at the end of the day, as long as you're underwriting your deals and they work for today's rates, you buy it,
Right.
right?
Right.
We're still shooting for the same level of returns for our investors that we were shooting for 2 years ago. It's the same number. We're still shooting for the same number. And we've had some people bring deals to us where the returns are lower than what we target. And we don't do those deals because our investors are not going to like it. So, yes, debt is like a huge concern. And everybody's talking about debt all the time. But at the same time, we're still buying deals because it meets our buying criteria. Now, the debt scenario and how much money you have to bring to the table and things like that continue to change time and time again. But at the end of the day, as long as the principles work, your debt coverage ratio is there, and that you're providing a level of returns for your investors,
Yep.
then you buy it, right? Because what's Warren Buffett's thing is you don't time the market, you spend time in the market. And it doesn't matter if the rates are high or low right now. If you buy it and hold it over a period of time, you're going to do okay, right? You only realize losses when you sell,
Right.
and everyone can relate that to stocks is, if I'm red, I'm not going to sell it. Well, same thing with real estate. If you don't have to sell it because you have balloon payment, you have debt that's extended over a long period of time, you just ride it out.
Yeah.
And I've had a lot of conversations with investors who really got accustomed to the return levels that were happening in 19, 20, 21, and 22 because they were like, oh, why are we holding this more than a year? Every other deal that I've been in and out of in the last 3 years, we've sold in 12 months. I'm like, well, because it's a different market and real estate as a whole is more of a long-term game than a short-term game. And we
Yeah.
have been playing more of a short-term game because of the rapid compression of cap rates due to the cheap debt, right?
Yeah.
But now we're starting to see a decompression of the cap rates, prices coming down or stabilizing a little bit better. And if you're predicting those reductions in cap rate and reductions in or sorry, decompression in your cap rate and your increased insurance costs and your taxes keep going up. Well, if anything starts to change back in your favor, now your property is significantly more valuable and you didn't really do anything. All
Yeah.
you did was own it.
Yeah. And that's a really good point, Tim, because that, like you said, if your property underwrites today at these rates and these market conditions, what's the problem? I don't kind of get that at all, right? Like, the people who are talking about, I can't buy today, I can't buy today. Well, you're not looking in the right place, because there are absolutely deals to be had that work at today's rates. And then the other thing I would say too is, people are always like, are you concerned about rates? Are you concerned about rates? No, because I don't have anything floating, right? Like that's been I had a conversation with a good friend of mine and Tim's, Will, yesterday, where we were talking about that, and I'm like, I don't have anything floating. I'm not necessarily worried about the rates, right? Like,
Mm-hmm.
as long as I have time and I'm locked, I don't, I'm not as concerned with what the rates do in the short term. Ask me in 2 to 3 years, when maybe I'm trying to refi something, but right now, I know what my payments need to be. My deals are working at these numbers, and like Vitali just said, if anything improves, then my deal really really works, right? Um, so big thing is, hey, if your deal works at 7.5%, go lock in at 7.5% and ride it, right? And hey, if rates come back down to 6 or 5.5, then refi then, and you're golden. You know.
Yeah. And now I'm surprised we haven't gotten any pushback yet, like in our comments and things on this conversation. But I'm not saying that you can't buy deals with bridge loans anymore. We've only bought one deal with a variable rate loan, and that was the most stressful thing that we've ever done, and I will never do it again. Right.
And we're not in it
Um,
anymore.
we're not in it anymore. Thank God. We were able to get out of that. But I'm
Out of
not
the
saying
debt.
that you
Out of the
can't
debt.
buy a deal with a bridge loan that has a high interest rate, that has a 2-year balloon. You can still do those things, but you have to underwrite them and you have to buy them right. There has to be a significant value add where you can increase the equity position a very, very, very large percentage. Because what I've seen on some people's underwriting files that they bring to us is they think you're going to get 70 to 75% leverage on a bridge loan acquisition, but then they're going to also refinance at say 75%. And that's might be possible 2 to 3 years from now, but at least in today's debt world, we're seeing refis in the 60 to 70% range, right? Even less. We've gotten a couple debt quotes that were 56% leverage on an asset. And it's you just have to underwrite for that, assuming that your leverage is going to be lower, your rate is going to be higher, But if you increase the value and the debt coverage is there, then you're still able to return some level of money for your investors and still make a deal work. Now, it
Yeah.
might not be the same bucket or the same business plan that you had before or expectations that you had before on being able to buy it and refinance 100% of your investors' cash out of the deal. Maybe you can do that, maybe you can't. But as long as you can still create value and create money for people, they're going to invest in your deals, especially if you have a pre-existing relationship with them and you have a proven track record. So
Yeah.
I'm not saying don't buy deals with bridge loans. Just be careful. Make sure that there's enough value add there. There's enough equity there to be had on your new rate, and just make sure that your refinance numbers are realistic and ultra conservative. I mean, if you want to be super careful, just underwrite everything that you're going to refinance it at 50% leverage or 55% leverage. And if you do better than that, great. But if your underwritten returns meet your investor metrics at 55% on a refinance, do the deal.
Yeah. Here's this is a little off topic, but I do want to I do want to kind of address this for a second because and by the way, Luke, thanks for asking. And if you were going to be in Cincinnati, I'm actually going to talk about this on Thursday morning at the Birth 360 conference. But here's here's what I would say. Sure. That's does anything on MLS work for cash flow, or are people forced to buy off market deals and get better deals? It's it it's not a blanket statement, right? Like there are things on MLS that work, there are things on LoopNet that work, there are things on Crexy that work. There's things off market that work, and vice versa. I've been presented, I can't tell you how many off market deals in the last month that don't work at all. Um, you know, I got one off market a couple of weeks ago in a market I really really like. The guy wants like two times what the property's worth. I wouldn't paid that for the property back in 2021. Um, so, what I'm trying to say here is you can't really rule out any place to look for a deal. Um, there's there's deals everywhere that work, and just because it's on MLS or on Crex or on LoopNet doesn't necessarily mean no that it doesn't work. At the end of the day, it really comes down to what your business plan is, what your investor profile is, what your strategy is for, what you're going to do with it. What are you trying to create? Like maybe there's something on MLS that creates a ton of equity for you because it's in a high appreciation market, but it's not going to cash flow. But what if you're an investor who doesn't care about cash flow and you're looking for something that's going to be like a big old nest egg 10 years from now, right? I don't care about the cash flow today, just needs to pay for itself. But I want a nest egg 10 years from now when I'm ready to retire from my job at 45 years old or something. Um, that might be a deal on MLS that works for you. It just all depends. And I'll say one other thing too. I've always heard this thing like what LoopNet or Crexy is where deals go to die or something like
Yeah.
that, right? Well, I'll tell you this. When I was looking for like one of my first multifamilies, there was a deal on Crexy that was a absolute gold mine, an absolute gold mine. And it would have been a life-changing event if I had been able to get the deal. I missed out on it by that much. Um, but that deal was a deal when it was on Crexy that day. It's an even bigger, better deal today when it just recently resold. So they're all over the place, man. You just got to find them. So
Would you say beauty is in the eye of the beholder, or opportunity is in the eye of the underwriter?
yeah, I mean, for sure. And look, one thing I would say as well is, you are right. Like you're more likely to find a better deal off market. Now, I don't think anybody's going to deny that. But part of that's because there's less eyes on it, if nothing else, right? If it's truly off market, you know, there's not 10,000 people sitting on their computer right now with access to just pull that deal up on some website and underwrite it and throw an offer out there. Um, so, yeah, off market deals are going to probably be a little bit better, but there's deals everywhere.
Yeah, yeah. I mean, I think it's a big misconception that off-market deals are the best deals. I
Right.
mean, are really great deals done off-market? Yes. Are
Mhm.
really great deals done on-market? Also, yes.
Yeah.
Right. So it just depends on what your investors' expectations are in terms of return and what your view of opportunity looks like and what is a good return for you, because what might be a good return for you might not be a good return for somebody else, right?
Yeah.
So like you can't blanket statement everyone expects X amount of return, because that's not true. Some people are fine with parking cash and getting a 5% return. Other people only want to see 30% plus,
Yeah.
right? So if you ask one person if it's a good deal and they say yes, and the other person says no, that's just because they have a different viewpoint on it. So you just need to determine, Luke, I think to summarize that, what you need to do is determine exactly what level of return you're looking for in your deals or on your money or however you're structuring your deals. Underwrite to those level of returns and make everybody an offer at that level of at whatever number makes that level of return good for you. So if you're looking for, I don't know, arbitrarily 15% cash on cash return, change your purchase price until you get to that level of return and make an offer and then move on to the next one. Don't get attached to any individual deal, because you never know if you're showing up at the right place at the right time and making an offer that somebody just wants to close with and move on with on their life.
Yeah. And then and to that point, one last thing I'll say on this is, we used to do this in the flipping world. If I saw something online that I was interested in, and I saw it at a number, I'm like, I don't think that's going to trade at that number.
And it
I'd
does.
mark it. Well, or I'd mark it and I'd sit there and watch it. And 6 months later, when it was still there at that number, then I'd start to call. I'd start to call that
Mhm.
person and go, "You tired of you tired of this? You tired of like having brokers call you on Saturdays and say you need to get out of your house and for 2 hours while I show it and then nothing come out of it because I can
Mhm.
help you solve that problem." Um,
Right.
so
Right.
you know, yeah, because hey, sometimes there's a deal in MLS that's just you just need to read into maybe there's some motivation there that you can help somebody solve, right?
Yeah, totally. So, all right. It was a good diversion. I like those kind of diversions. But so debt market predictions. The other part of what I wanted to talk about, and I kind of did touch on this already, was how are our predictions or our forecasting changing the way that we're looking at our deals? I've
Hmm.
said this before, and I'll say it again. Any deal that we have under contract, probably once a quarter, I'm adjusting the underwriting to see what the numbers look like. Because as you own deals, they continue to grow, they continue to change. The rent numbers might change, the insurance might change. Definitely has changed over the last 12 months. A lot of insurance has doubled or even tripled. So, we're constantly looking at deals and we're stress testing them to see what level of returns for our investors make sense. And sometimes, I mean, we're selling a couple deals right now because at the end of the day, we could have refinanced some of the deals that we're selling, but it made more sense for our investors to sell it, realize some gains, and then move it into a new opportunity. Because, yeah, you could refinance it, which is what you were trying to do originally, but now you can only get 55% leverage. Okay, so now nobody's going to get their money back. They're still going to make a return, but the longer you hold a deal, the lower your IRR goes, right? Because time value of money. So we're constantly kind of adjusting and reevaluating what we're doing with our deals based on the debt markets today, the average rents that we're achieving today, and our total overall expenses that we're achieving today. Because since we went vertical with our own Vive property management company, we've been able to reduce our expenses drastically and keep our rents the same, or if not increase them. And that has changed the landscape of our deals too. So it's really hard to have a conversation and tell you exactly what we're going to do on any given deal. Because again, when you're buying deals, like all of this underwriting is all forecasting and it's presumptions at the end of the day. But you're continually evaluating and readjusting and saying, you know, in my investors' best interest, what is going to serve them best in order to get the highest level of return. And sometimes that's selling, sometimes that's refinancing, but it's constantly evaluating and having conversations of what the possibilities are. Because the last thing that you want to happen is to get caught with your pants down because you haven't thought about this deal in 12 months. You've never looked at the debt rates in the last 6 months, and you got a balloon payment coming due in 60 days, right? Like you never want to find yourself in that position, and it's important that you stay on top of these things because you could lose a lot of money and a lot of investors'
Yeah.
money too if you're not on top of it.
Yeah. Yeah. Well, and guys, this is a little bit of an extreme, right? But there's stories coming out all the time about guys who weren't on top of it, right? They made
Oh,
bad
just what
assumptions,
was it?
right?
Was it like Apple Gateway or whatever? The Houston deal that went under last year or earlier
Well,
this year. I
And
can't remember.
there was
There was
another
another one
one,
recently.
yeah, in Houston again.
Oh, again in Houston, yeah.
Yeah, that went under. But you're seeing that. I
Mhm,
mean, I can remember about a year and a half ago, probably early 2022, sitting with someone and they were literally convinced that we were going to see negative rates, right? Like we were going to see negative rates. They were like, Germany's doing it. I'm like,
I remember that
yeah,
conversation now that you just bring it
yeah,
up.
yeah, and
I'd love to
but
see some negative rates right now.
yeah, but look at where we are. And guys,
Yeah.
here's one other thing I would say too is rates really aren't that high. They only feel as high as they are because we were as low as we were, is what I would tell you. Is because 7% historic. I mean, go ask people who were buying properties in the 70s and early 80s, even the mid 80s, right? Go ask them what they think about 7%.
Mhm,
Because they were buying at 10, 11, 12, 18%, right? So yeah, I mean, 7% feels painful, and believe me, I like it much better at 5% too, but 7% historically is not that bad. It just feels bad because of where they were, and then I'll add one other thing to that, because the way prices escalated over the last couple of years. Those 2 things that they're gonna take some adjustment, right?
mhm.
By us and the Fed. I think the Fed's gonna have to sometime in the next year, I think the Fed's going to have to say, hey, the real estate market has done this. It's become unaffordable. So what can we do on our side? Um,
Mhm. Yeah, I
drop
mean,
rates a
what's the
little bit.
average home price now? It's like $430,000 or something?
Yeah, man. I mean, I was looking at something the other day, you go buy $1 million property and you're looking at what, 7 grand a month in debt service,
Is it that high
easily.
now? My rule of thumb was always 5,000 per million.
Yeah. So it's somewhere in there.
Mm,
And, you know, uh, No, that's I mean, I know I'm talking about $1 million, but just half that, on a $500,000 purchase, you're talking 3,500 a month,
mhm,
right?
mhm,
Because I can tell you, my debt service is like 1,700 a month,
mhm. But that
and
you got a rate in like the 3s or something crazy, I think.
2.85.
Yeah, yeah, right. So rub it in a little bit.
Free money, baby.
It is free money. It's low. Yeah, it's free money.
Yeah. When do I think rates will start to come down?
We kind of covered that a little bit earlier, but we don't know. I mean, we'd like to see. We're optimistic to see some change in the next 12 months, but the Fed doesn't even know what they're going to do with the rate. So I'm hopeful by this time next year we'll have conversations around rates are starting to go down, or the Fed has announced that that they are going to reduce the rate. So
Yeah.
that's what I think.
Um, in a nutshell, to recap that earlier conversation, I made a prediction in January and I was wrong.
Yeah, that too. Yeah, right. Because yeah, I mean, in January you thought they'd be coming down towards the end of this year, and
Hey,
they're not.
we'll throw some things out there, right? Like
Yeah.
supposedly a recession's coming. It's been coming. Sounds like maybe we might see it in Q1, Q2. Next year's an election year.
Oh yeah, election year. I think we do. I forgot about that. I think we do
Mhm.
start to see rates come down right before the election in order to kind of boost some votes.
Politicians sure like to look good when their name's on a ballot. So,
Yeah, that's for sure.
so
So
I don't know. I think there's some factors at play that could help us out next year. But again,
who
that's
knows?
all speculation,
I
man.
wish I had a crystal ball because I'd be a gazillionaire by now.
Yeah.
So all right, guys. Well, that's all the time we got for today. Appreciate everyone joining the show. Hopefully, we added some value to you and at least showed you a little bit of the insight into some of the conversations that Tim and I have, and how we're constantly looking at our deals, reevaluating debt, reevaluating refinances versus exits versus changing the business plans. I mean, it's constantly ebbing and flowing. So there's no blanket answer. There's no right answer. It is just continually dealing the hand that you're dealt, right, or playing the hand that you're dealt. So, with that, Tim, why don't you take us out?
Yeah. And one thing, a good lending broker guy on your team is
Oh,
huge.
invaluable.
Invaluable. Big shout out to Craig on that one. So, all right, guys, have a wonderful week. See you next week. And if you're in Cincinnati, stop by Burr 360 and check us out.
Cool.
See ya.
Peace.